Hey everyone, Greg Towner here with Parallel Portfolios, and it is time for the July 5 charts in 5 minutes. So let's get right into it. Well, of course, we like to start off with a 3-year look at the S&P 500, which is this blue line here. The orange line is the 200-day moving average of the S&P. And as you may be aware, the market is still trading right around all-time highs, just slightly off of it. Have been a really good run of late. I know sometimes get investors get nervous when markets reach an all-time high, but if you look historically, strong returns from the market usually indicate further strong returns, particularly as you look out, say, 3 to 12 months. Yes, in the shorter term, 1 or 2 months, there can be some volatility, and we may see that now. We're going into historically a weak seasonal period. There's, of course, still a lot of talk about tariffs. There's going to be more talk about government shutdown. Who knows what else. So there, of course, can be volatility in the shorter term, but that is just simply the shorter term. Strength normally means further strength as you look out further. So we're using that as our base case for now. Well, beyond the equity markets, of course, investors are always looking at interest rates. This is a look back at the 10-year yield, currently around 4.5%. It's really been trading in this sideways range for about 2 years now. Investors are really focusing in on, is it eventually going to break out to the upside, or is it going to move down to the downside? Not a lot of indications from it right now. But one of the reasons that investors are so focused on this right now is because of how it ties in with inflation. Going to sneak in a couple of charts on this page here. But basically, we've received some inflation data this week that was kind of moving in both directions. Here on the left-hand side, going back 10 years, and the Consumer Price Index, CPI, that came out this month just a little bit hotter than expected. It ticked up, underlying the surface, some concerns that maybe tariffs were in fact starting to hit some of the data. Inflation was moving up a little bit. And then just after that, the day after that, we received the Producer Price Index, the PPI. That actually ticked down month over month and came in a little bit better than expected. So a little bit of noise here in inflation data, and that's going to be very critical as the Fed meets in September to decide if they're going to lower rates or not. Right now, the market is indicating only about a 50% chance that they do, but of course, there's going to be more data that comes in between now and then. So let's turn away from some of the shorter term charts and focus on some longer terms. I thought this was a really interesting chart. We're not really looking at a potential of a recession here in the near term, but I thought this might be interesting to some investors. This looks at both the length and years of recessions over time, and then you can look at the size of the bubbles to know how bad the recession was in terms of how much the GDP declined. This is the time frame down here. So the Great Depression, of course, is a big outlier in both in the decline as well as the length of it. But you look at all the other recessions over time, they mostly were around a year or so, a couple higher, the number of them lower. Yes, a couple of the bubbles are quite large, big impact on the economy, but most of them were fairly moderate. Of course, in hindsight, at the time, none of them felt good, and you never know how bad they're going to get. So think about that as a framework as we go to this next chart, which is one I really like. This goes back to the 1950s and looks at all the major bear markets and labels them here, the different ones, the tech bubble, the pandemic, and so forth. And what we look at is on the y-axis here, going up and down, we can see that the color is indicated for each bear market, how much they decline in percentage terms. So we can see some of them did hit 50%, pretty severe. The time-wise, maybe a year or two or so. But now let's look at to the upside, the resulting bull markets after those bear markets. Much higher returns on average. Low end was 100%, and many of them went to many hundreds of percent. In terms of years, you're looking at a couple of years at the low end and, and many, many years to the out end. So right now, this green line is what we're using as a baseline from, if we consider that 2022 bear market that occurred, most stocks were down over 20% or so. Both in terms of percentage return and in terms of length, we still potentially have a lot further room to run compared to most historical norms. So I think a lot of investors get concerned about, well, we've had this big long run, and we have in some respects, but as you focus out on the longer term, there's actually potential for more upside. So in closing, we just want to talk about how market strength historically has resulted in future strength, looking out, say, 3 to 12 months. There can be some volatility in the shorter term, and perhaps we'll see that. but bull markets last much longer than bear markets. And I think that's both of those two factors combined are just more evidence to why investors should focus on longer time frames and try to avoid the shorter term noise. So with that, we will leave you for now, but look forward to speaking with you again in the near future. Thank you.